Good day everyone, I am Shaina Teliago. Today I'll be discussing Chapter 21, Reclassification of Financial Assets. Before we begin, let me emphasize that what I will present are theoretical concepts based on PFRS 9, the accounting standard for financial instruments. You may wonder, why focus on theory? The reason is simple. Understanding the underlying principles ensures that we approach financial reporting with precision and compliance. The reclassification of financial assets is an area where mistakes can lead to material misstatements, especially when businesses evolve and their objectives for managing financial assets change. So by the end of this discussion, I hope to provide clarity on when and how reclassification is applied and to explain the importance of these principles in the context of financial reporting. So, our discussion for today has four key objectives. First is to know the requirement for the reclassification of financial asset between categories. Second is to be able to recognize the reclassification of financial asset. Third is to identify the financial asset that can be reclassified to other category. Then last is to identify the exemptions from reclassification of financial assets. Now let's dive deeper into these concepts. Let's go to the requirement for reclassification. Reclassification of financial assets is governed by PFRS 9. This standard provides a clear framework to ensure consistency in reporting. So when can reclassification occur? So according to PFRS 9 paragraph 441 provides that an entity shall reclassify financial assets only when it changes the business model for managing the financial assets. So when we say a change in the business model, this refers to a significant and demonstrable shift in how an entity manages its financial assets. Like for example, a company might decide to transition from holding assets for trading purposes to holding them to collect contractual cash flows. How is reclassification applied? So according to paragraph 561, reclassification is applied prospectively from the reclassification date. So this means that gains, losses, or interest previously recognized are not restated. So the reclassification here impacts only future reporting periods. As defined also in the Appendix A of PFRS 9, the reclassification date is the first day of the reporting period following the change in business model that results in an entity reclassifying financial asset. So this means that if the change in business model is in 2021, the reclassification date will be on January 1, 2022. Although the reclassification is applied prospectively, the change in the business model must be disclosed in the financial statements of the year it occurs. This is because such changes are significant events that affect the entity's financial position and performance. Now let's go to the exemptions from reclassifications. So we have a general rule here. According to PFRS 9 consequential requirement, equity investments cannot be reclassified under any circumstances. However, it is also essential to understand that not all financial assets are eligible for reclassification. So, PFRS 9 provides specific exemptions. First are the equity investments. Equity investments held for trading or measured at fair value through profit or loss cannot be reclassified. Why? Because these are managed on a fair value basis, and their classification is inherently tied to this purpose. Equity investments measured at fair value through other comprehensive income by irrevocable election cannot be reclassified also. The key term here is irrevocable election. So once a company chooses to classify an equity investment as FVOCI, it cannot reverse this decision. Debt investments, on the other hand, are eligible for classification because their classification is closely tied to the business model. However, if a debt investment is measured at FVPL by irrevocable election, it cannot be reclassified. Again, the irrevocability of the election prevents any changes. So these exemptions from reclassification highlight the principle that reclassification is not meant to be used arbitrarily. Instead, it reflects genuine changes in how an entity manages its financial assets. Let's now explore how reclassification works in specific situations. Each scenario has unique requirements under PFRS 9. So let's go to the reclassification from FVPL to amortized cost. PFRS 9 paragraph 563 provides the following if a financial asset is reclassified from FVPL to amortized cost. So here's what happens. The fair value at the reclassification date becomes the new carrying amount. The difference between this new carrying amount and the face value of the financial asset is amortized over the remaining life of the asset using the effective interest method. And lastly, a new effective interest rate is calculated. So why is this necessary? Reclassifying from FVPL to amortized cost reflects a shift in the business model from managing assets based on fair value to focusing on collecting contractual cash flows. Next, we have the reclassification from amortized cost to FVPL. So, PFRS 9, paragraph 562 provides that when an entity reclassifies a financial asset from amortized cost to FVPL, the fair value is determined at the reclassification date. So, any difference between the previous carrying amount and the fair value is recognized in profit or loss. This reclassification aligns with a shift toward managing the asset based on its market value rather than its contractual cash flows. We have also the reclassification from amortized cost to FVOCI. So PFRS 9 paragraph 562 provides the following if a financial asset is reclassified from amortized cost to FVOCI. So here's what happens. The financial asset is measured at fair value at the reclassification date. The difference between the amortized cost carrying amount and the fair value at reclassification date is recognized in other comprehensive income, and the original effective interest rate is not adjusted. The key point here is that the original effective interest rate remains unchanged. We go now to the reclassification from FVOCI to amortized cost. PFRS 9, paragraph 565 provides the following if a financial asset is reclassified from FVOCI to amortized cost. So first, the fair value at the reclassification date becomes the new amortized cost carrying amount. Second, the cumulative gain or loss previously recognized in other comprehensive income is eliminated and adjusted against the fair value at the reclassification date. So as a result, the investment is reverted back to the amortized cost measurement. And lastly, the original effective interest rate also is not adjusted. So, kani siyang adjustment ensures that the financial asset aligns with the new measurement objective, katong collecting cash flows rather than fair value changes. Next, we have the reclassification from FVPL to FVOCI. PFRS 9 paragraph 566 provides the following if a financial asset is reclassified from FVPL to FVOCI. First, the financial asset continues to be measured at fair value. Then the fair value at the reclassification date becomes the new carrying amount, and the new effective interest rate must be determined based on the new carrying amount or fair value at the reclassification date. So lastly, we have the reclassification from FVOCI to FVPL. PFRS 9 paragraph 567 provides the following if a financial asset is reclassified from FVOCI to FVPL. So here's what happens. The financial asset continues to be measured at fair value. The fair value at the reclassification date becomes the new carrying amount, and the cumulative gain or loss that is previously recognized in other comprehensive income is reclassified to profit or loss at the reclassification date. So, why are these rules important? The reclassification rules under PFRS 9 serve several purposes. First, for the consistency, they ensure that the financial reporting reflects the entity's business model. Second is the transparency. The disclosures provide stakeholders with clear insights to significant changes. And third is avoiding arbitrary changes. These restrictions prevent entities from manipulating classifications to achieve desired financial outcomes. So in summary, reclassification of financial asset is not a routine process. It is tied to significant changes in the entity's business model. So the principles outlined in PFRS 9 ensure that such reclassifications are transparent, consistent, and meaningful. Although this discussion focused on theoretical concepts, these rules have real-world implications for financial reporting and compliance. And I hope this presentation has provided clarity on the importance and application of these principles. Thank you for your attention, and I am now open to any questions you may have. You may leave your comment down below. Thank you.